In this video, I'm going to cover some common valuation metrics such as the price to earnings multiple and the PEG ratio. I'll also go over the differences between the trailing and forward PE multiples and how you can use all these different metrics when looking at a stock to help you find good investment opportunities. Let's start with a conventional price to earnings multiple. The multiple considers the stock's price, which is the P, and its earnings per share, which is the E, the denominator. The price will always change, so the ratio will change along with the stock's movements. When a stock goes down, the PE multiple will also come down as the stock looks cheaper with respect to earnings. The EPS will change as well, but not as frequently. It'll change as the company releases earnings. The trailing PE, which is what people are typically referring to when they are just talking about the PE multiple, looks at the company's earnings per share over the past 4 quarters. Hence, it's looking at the trailing earnings. Let's look at Amazon stock. It's trading at a PE multiple of around 37 right now. Its share price is at around $232, and its earnings per share over the trailing 12 months, which is what this TTM acronym means, was 6.13. So if you take 232 and divide it by 6.13, you get a price to earnings multiple of just under 38. If the company's earnings rise in the future, then the EPS will rise and the PE multiple will come down. It'll be a better buy if its price stays the same, since it'll be cheaper with respect to earnings. But the big drawback about the trailing EPS is that if the company has a bad quarter where it has a goodwill impairment charge or another one-time expense that weighs down its bottom line, its earnings can look worse. And now if you look at a stock, its PE multiple may look very high and seem like a bad buy. Let's take a look at drug maker AbbVie as an example. Its trailing PE is over 80. That looks incredibly expensive. But why does it look like such a bad buy? The reason is that the company's Q4 results are weighing down its EPS. Back at the end of 2024, the company incurred IPR&D expenses, which are costs related to a recent acquisition. This isn't a recurring expense, but it still impacts the bottom line. In this case, if you're looking at AbbVie's PE multiple and seeing such a high multiple, you might think this stock is a bad buy. And if you're only looking at stocks with low multiples on a stock screener, this one wouldn't come up, even though AbbVie isn't a bad stock to own. Now let's look at its forward PE multiple. It's only 16, so what gives? The forward PE is based on its future earnings. No one has a crystal ball, of course, but it's based on analysts' expectations of what the business's EPS will be over the next 12 months. Of course, analysts can be wrong, and I used to wonder what was the point of relying on this metric. But the reality is that a forward PE multiple is not going to include non-recurring items. It's not going to have these acquisition-related expenses. It's what you might expect the company's PE multiple to look like under normal, typical conditions. Sure, there's some growth going to be factored in here, but this PE multiple can be more indicative of just how expensive the stock really is. And when there's such a big delta between the forward PE and the trailing PE, that's a hint that the business probably had at least one bad quarter in the past, especially if it's an established company that's usually profitable. The key thing to remember, however, is that if you're comparing stocks based on their multiples, make sure you're comparing forward PE against forward PE and not comparing a trailing earnings multiple against a forward earnings multiple. Otherwise, it's not an apples to apples comparison. Typically, you'd expect the forward PE multiple to be lower than the trailing PE multiple simply because businesses are expected to grow their earnings. Now, let's look at the price to earnings growth ratio, or PEG. Think of this as the forward earnings multiple, but over a longer time frame, typically 5 years. Let's go to a fast-growing stock, NVIDIA. Its forward PE is just under 39, but its PEG is around 1.7. So what does this mean? The PEG looks at the company's current PE ratio, its trailing multiple, and it's dividing that by the growth that analysts are expecting from the business in the years ahead. So if we know that NVIDIA's trailing PE multiple is 56 and its PEG ratio is 1.7, we can work backwards to determine what the expected growth rate is that analysts are projecting over the next 5 years. Taking 56 and dividing it by 1.7, we arrive at around 33. Analysts are projecting that NVIDIA is going to grow by an average annual rate of roughly 33% for the next 5 years. Generally, when a PEG ratio is 1 or less, the stock is considered cheap. The higher it is, the worse of a buy it is. NVIDIA's stock price has been rising lately, and now its PEG multiple is 1.7, whereas in the past, it was below 1. The risk here is that you're basing a lot on analyst estimates. The forward PE looked at just the current year ahead, but with the PEG, you're now looking at 5 years. It's obviously a lot harder to forecast 5 years than it is to forecast 1, so there's definitely more risk and uncertainty here. All these multiples, however, are best used when compared to other stocks. And you can also look at what the average is for the S&P 500, the NASDAQ 100, and Russell 2000 to give you an idea. If you go to WSJ.com, there's a page, and I'll leave a link in the description for this video, which shows you what the PE multiple is for these indexes, what it was a year ago, and the estimate or forward PE. It's one way you can gauge how cheap or expensive a stock you're looking at is in comparison to these popular indexes. There's no perfect earnings multiples to look at, but at least by understanding them, you can get a better idea of what they mean and to help you understand whether a stock is indeed a cheap buy or not. But just keep in mind the danger of filtering out stocks based on their PE multiples, because if a company had a bad quarter or it incurred a big acquisition related expense, you might miss it on a screener, even though it may not be as expensive as it appears to be at first glance. So which multiples do you look at when buying stocks? Let me know in the comments. If you enjoyed this video and learned something from it, please leave a like and be sure to subscribe for more. Thanks for watching.